Hello and welcome back to Ground Up Accounting. In our last episode, Ground Up Coffee made its very first sale. A customer walked through the door, bought a latte, paid immediately with their bank card, and we recorded the transaction in our accounts. Everything was straightforward. Money came into the business at exactly the same time as we made the sale. But business doesn't always work that way. As companies grow, they often begin trading with other businesses rather than just members of the public. And when businesses trade with each other, something very common happens. They don't always pay immediately. Instead, they ask for credit. Imagine that a local architectural practice has become a regular customer of Ground Up Coffee. Every Friday morning, we deliver coffee and pastries for their staff meeting. At the end of the first delivery, the office manager says, "Thanks very much. Can you send us an invoice?" We normally pay our suppliers within 30 days. Now, let me ask you a question. Have we made a sale? Well, absolutely. Have we been paid? Well, absolutely not. The coffee has been delivered. The customer has received everything they ordered. But not $1 has entered our bank account. This introduces one of the most important ideas in financial accounting. A business can earn revenue today and receive cash weeks later. The amount that customer owes is called accounts receivable. You may hear this term trade debtors as well. However, they mean exactly the same thing. Now, accounts receivable is simply money owed to our business by our customers. It is recorded as an asset on the balance sheet because it represents something of value. We have a legal right to receive that money in the future. Think of it like an IOU. The customer has our coffee. We have their promise to pay. Let's keep our example simple. Ground Up Coffee supplies coffee and pastries to the architectural practice. The selling price before tax is $200. The sales tax at 10% is at $20. So the total invoice is $220. And the customer has 30 days to settle. Now notice something important. No cash has been received. Our bank balance has not changed. Our business has become richer because someone now owes us money. Now that's exactly what our accounting records must show. Whenever you're unsure how to record a transaction, ask yourself the question we've been asking since episode 1. Which accounts have changed? First, accounts receivable has increased. The customer now owes us $220. Now that's an asset. Second, coffee sales has increased. So we've earned revenue of $200. Finally, sales tax payable has increased because we've collected $20 of tax on behalf of the government. So the journal entry is, if you look at the accounts, the accounts receivable, we're going to debit $220. And we're going to credit the coffee sales, the income side of it, at $200, and the sales tax payable at $20. So there's our journal balancing out. So that is one transaction, 3 accounts, exactly as we've seen throughout this series. Of course, we didn't simply create an invoice. We also supplied coffee, milk, pastries, cups, and other inventory. Now, these items have now left our shelves. Let's assume they cost us $80. That means we need another journal. So let's look at that journal. So on our account, we've come across cost of sales before on our P&L. We're going to debit that $80, and our inventory account or stock account on our balance sheet, we're going to reduce by $80. Now, this journal records the cost of supplying today's order. Notice that it has nothing to do with whether we've been paid. The inventory has gone. The expense has been incurred. Therefore, we must recognize this today. Now, at first, this might feel strange. Many people naturally think that income should only be recorded when money arrives in the bank. But imagine waiting 30 days before recording today's sale. Our accounts would suggest we had done no business at all during the month. Now, that wouldn't be true. Financial accounting is designed to record economic events when they happen, not simply when cash moves. That's why today's profit and loss account will include today's sale, even though today's bank account hasn't changed. It gives us much more of an accurate picture of how the business is performing. I'd like you to also consider one thought as well before we move on. Many new business owners look at their bank account. If a bank balance is healthy, they assume the business is also healthy. If the bank balance is low, they assume the business is struggling. In reality, neither assumption is always correct. A business can be highly profitable and still be waiting for customers to pay. Equally, a business can have plenty of cash today, but still be losing money. That's why accountants don't rely on the bank balance alone. They look at the complete financial picture. And that's exactly what we'll do in this episode. Now, if you open whatever accounting software you use and try and record today's 2 journal entries, remember, it doesn't matter whether you're using Sage, QuickBooks, Xero, SAP, or even a manual accounting system. The accounting principles never change. Every accounting package is built on the same foundation: double entry bookkeeping. The software is simply the tool. Understanding the accounting, well, that's the skill. So pause this video if you'd like to enter those transactions into your own software. When you're ready, let's see how those entries affect the financial statements. So let's look at our trial balance now to date. So we are going to look at our updated trial balance for ground up coffee, And as you can see, all the accounts we've created to date with the addition of our accounts receivable and our sales tax payable has increased also from our earlier journal. Once again, every debit equals every credit. That tells us our books remain in balance. And remember, the trial balance doesn't tell us whether we've made a profit. Its purpose is to confirm that our bookkeeping entries balance before we prepare our financial statements. So let's turn our attention to the profit and loss account. So as we can see to date, we have now increased our sales revenue to $205, less our cost of sales, which is now amounts to $81.80. So as you can see, we have a gross profit equaling $123.20. Our operating expenses then includes our depreciation expense, which we recorded in a previous episode. So we are currently trading at a net loss of $43.47. So although we've made another sale, notice something interesting. Our bank account hasn't increased, yet our revenue has. Now that's because financial accounting records revenue when it's earned, not when the money is collected. The sale has improved our profitability, but the cash is still outstanding. So let's look at our balance sheet. We can see then our current assets now include bank and accounts receivable is the new kid on the block. Our inventory and our tax recoverable accounts there under our current assets are there. And then we move on to our non-current assets. So there's our coffee machine and our accumulated depreciation. Remember, we're still in the first month, so we've only recorded 1 month of accumulated depreciation. In month 2, we'll record another 166.67, but we'll get to that in another episode. So there, our total assets, which is our fixed and current assets, total 64,277.03 cents. So let's look at our liabilities and equity then. So there's our accounts payables, our sales tax payables, and on the equity side of things, our owner's capital at 50,000. But look at the current year loss, which is our profit and loss, 43.47 from our P&L. So when you add the total equity with the liabilities coming in at 64,277.03 cents, and that agrees our balance sheet. So notice that our balance sheet now contains, as I mentioned there before, a new asset, accounts receivable. Now this represents money owed to Ground Up Coffee by one of our customers. Remember, it isn't cash, but it is still an asset because we have the legal right to collect it. So let's recap on some of the key things we've learned in today's episode. A business can make a sale without receiving cash immediately. Money owed by customers is recorded as accounts receivable, which is a current asset on the balance sheet. Revenue is recognized when it's earned, not when the cash is received. Every credit sale still requires a second journal entry to record the cost of sales and reduce the inventory or the stock. The trial balance confirms that every debit still equals every credit. The profits and loss account measures how the business has performed during the period, and the balance sheet shows what the business owns and what it owes, and the owner's investment at a specific point in time. Now, these three financial statements working together, each one will tell us a different part of the story, and together they give us a complete picture of the financial health of Ground Up Coffee. Now, today's lesson has introduced one of the most important concepts in financial accounting. Making a sale and receiving the money are not always the same event. Many successful businesses sell on credit every single day. Their profit and loss account may show healthy profits, while their bank account is still waiting for customers to pay. Now, understanding that difference is fundamental to understanding business. In our next episode, we'll continue the story of Ground Up Coffee as our customer settles their accounts. We'll learn how to record the receipt of cash, reduce our account's receivable balance, and see how collecting debts affects both the balance sheet and the cash position of the business. Thank you for watching. Now, if you found this episode helpful, please like the video, subscribe to the channel, and share it with anyone who wants to understand accounting from the ground up. I'll see you in episode 6.